Welcome to Investor Copilot. I am Viraj, and today we'll discuss some additional metrics that will help you understand the quality and performance of a stock when you're making your investment decisions. So let's get started. The first metric we'll look at today is dividend yield. So when you purchase a stock, it is always a bonus or an added advantage to receive a dividend at the end of half a year or the entire year. And this is an added bonus apart from the price appreciation of the stock that you're looking for. So always look forward to this added income, and any company that pays healthy dividends should always be on your portfolio. The formula to calculate dividend yield is dividend per share divided by the market price of the stock multiplied by 100 to express this as a percentage. Generally, a dividend yield of 5% or more is considered very healthy in the Canadian markets. Something around 7 to 8% or more is considered very healthy in the US markets. So always check for dividend yield, and it's worth investing in a good stock where you have the other metrics to your liking and dividend yield is healthy as well. The next one that we will look at is dividend growth rate. So the rate at which the dividend grows for a 3-year period or a 5-year period is publicly available, and this defines the dividend growth rate. This is also an important metric and lets you know that the company is profitable and declares good dividends and pays you good dividends in the long run. The formula is pretty simple for dividend growth rate is the current dividend divided by the previous period's dividend, and as a whole this is multiplied by 100 to express this as a percentage as well. Lastly, we will look at something called beta. Uh, this is a metric which is often overlooked but very important when making investment decisions if you want to look at volatility as one of the metrics. So though I would not go into the formula for beta because it is rather complex, but to cue you in on what beta does, it basically establishes a very strong correlation between the price of the stock and the trend at which the index is going. So, what does this mean? Let's say you have a stock with a beta less than 1. What it means is that the stock is likely to be less volatile than the market, than the index that the stock is listed on. And a beta of exactly 1 indicates that the stock is in conjunction and in very tight correlation with the volatility of the index that we are talking about. Lastly, the stock where beta is greater than 1 indicates that the stock is much more volatile than the index itself. There are instances where the beta is negative, and this indicates that the movement of the stock price is likely to be inversely proportional to the movement of the index. These are rare instances, but let's say there are some instruments where the price of that instrument depends on markets in such a way that it moves in inverse proportion, inversely to where the market trends. That is where a negative beta comes into question. So while making decisions for your portfolio, you should look at beta to counter the volatility and understand what is the safety net and how much of a risk you can take with a stock. A stock with a very high beta should rather be avoided if you see that the other parameters, other metrics of the stock are not to your liking. So please pay attention to beta as a fundamental indicator as well. In upcoming videos, we will look at checking all of these metrics that we discussed, such as PE ratio, PEG ratio, debt to equity ratio, dividend yield, dividend growth, as well as beta and some other metrics online as well. So stay tuned. Thank you.